Just to give some background, I run the UK Centre for Financial Computing, which is a collaboration between UCL, the London School of Economics, the London Business School, and the major investment banks. And for the past 7 years, we've built algorithmic trading systems with a lot of the banks. And we're now working on risk systems with the Bank of England and the regulators. I'm going to show the next slide, and probably I shouldn't. It's called, in engineering, there's a thing called a normal accident. And the reason I'm showing this is that the problem we have with high-frequency trading systems is that the algorithms are becoming so complex that we don't really understand them. And particularly, we don't understand their interaction. And when you get a very complex system like this, you must expect future flash crashes as one consequence. And this is not to do with high-frequency trading. It was actually said about the 3 Mile Island disaster. And obviously, if you really get it wrong, you've got Chernobyl. Going to an example that's been discussed today about one of the downsides of the complexity of the algorithms is that you get intention consequences, or algorithms are being blamed for things that in fact probably they had nothing to do with. What you see here is the precipitous drop in the value of the market, but actually what the algorithms were doing was really just magnifying what was going on. And equally, there's the upside. It was probably the algorithms that actually pulled it back up again within the 20-minute period. Now, the key thing what I'd like to address is stability, and that is we've got a set of algorithmic trading systems that are increasingly complex, increasingly fast, and we don't really understand how they interact in the marketplace. Secondly, we don't know the behaviour of individual algorithms, and particularly the level of risk. So you could have a well-behaved algorithm that might have some inherent flaw in it, which could kick in later. The other thing that's interesting, one of the things we're doing with the Bank of England is we're trying to model systemic risk using computational ecology models, which might sound a little bit bizarre. These are the things that they use to model like the Amazon forest and such like. And one of the simple things from ecology is when you lose diversity, the system can become very fragile. And one of the things that's happening in algorithmic trading, the sort of best of breed, you're finding that a lot of companies are using actually the same algorithms or parts of algorithms, which probably isn't a good thing for the overall system. And one of the things you need to address is the fact that the other speakers are representing well-run, large institutions. There are a lot of very small institutions that are putting algorithms into play without adequately testing them, and these are the ones that are likely to cause problems in the future. And the final thing, MiFID. If you're talking about stability, when you introduce new regulation, we can't test it before it hits the market. It might actually increase instability, or as some of the other speakers have talked about, actually drive the markets away from Europe and to other countries. So one of the things when they say, should we ban algorithmic trading, I'd say algorithmic trading is really just the industrialization of the trading process, which is, using the analogy about Rolls-Royce, it's like putting robots in the car factories. I don't think anybody would reasonably assume that they were going to have a mainstream car manufacturer if it wasn't heavily using robots. And I think it's the same thing with the trading system. So what we need to do is not talk about regulating it out of existence or causing problems like minimizing the holding time and things like that, but how you can actually make it so that it actually works more effectively. And part of this is not putting in regulations that actually could actually reduce the stability in the market. So two things that I'd like to fly. One is it possible that we can actually certify algorithms, particularly from the smaller players, before they're actually deployed in the marketplace? And the other thing is there's some very good simulation technologies, again, you could say algorithms around. Is it possible that we can actually simulate financial regulations before we actually deploy them and see what impact they might cause? There's been a lot of discussion about terminology. What I've tried to do there is to put up what I think are fairly sort of standard terms in the industry. The first one is algorithmic trading. The term is used both for high frequency and low frequency. And some people use the word systematic trading, and then just use algorithmic trading for just the execution part. And then there's obviously high frequency and ultra high frequency. This actually is the process that's actually going on. If you look at the middle, you'll see there are three boxes there, which are the three key parts of algorithmic trading, which is pre-trade analysis, trade signal generation, and actually execution. Most of the discussions that are talking about regulating algorithmic trading actually are talking about the trade execution part, whereas the majority of actually work in algorithmic trading is actually in the pre-trade analysis. So you could even have low-frequency traders that would be doing most of their work in the pre-trade analysis stage, and then doing the rest by hand. This is actually the structure of a typical high-frequency or algorithmic trading system. At the pre-trade analysis stage, you've got three models. The alpha model, which is doing the forecasting, the risk model, which is trying to evaluate the potential risks, and then the transaction cost model. This passes on the information to the portfolio stage, where it's actually constructing the ideal portfolio that you'd like to hold. And then finally, you've got the execution model. Now, the key thing here is that the bit that we probably don't understand very well is the alpha model. Most of the other bits are typically down to people doing bad implementations. The other thing is that in the risk area, I would say that a lot of things in risk don't work very well. We could even, maybe it's an exaggeration to say, which it is, most of the risk algorithms don't perform more than just for a day or so. And then, just move on. No, just go back to there. There's a sort of structure of different techniques that people approach for building their alpha models. The one thing I want to point out here is there are so many decisions that need to be made in the implementation, like, what time period you're interested in, what your bet structure is. There's probably 1,000 different variables that you need to get right just in that one model for it to perform well. And I put that up to try and indicate the level of complexity that's involved. There was, one of the other speakers said about that there wasn't any, I believe he said there wasn't any evidence of quote stuffing. Was that correct?
Correct.
I think that
no evidence of quote stuffing in relation to market abuse.
But there is quote stuffing.
Well, whatever your definition of quote stuffing is.
Because
So quote stuffing is something that's willful.
That there is a chart of trading, and you can see the quote stuffing.
Well, it's putting in quotes. I mean, if you say quote stuffing, it implies malicious intent. Yes. There is no evidence In the SEC CFTC report, there's no evidence of malicious intent.
Okay, well, okay, we agree to differ. The other thing about the flash crash is, which is an indication of the complexity, is there's still no definitive agreement on what caused it. Here are some of the quotes that people have said, so-called fat finger, where somebody hit the wrong key. There are various stop-loss triggers and delays that didn't work. Quote stuffing, yes, malicious quote stuffing has actually been ruled out. But the key thing here is it's so complex we still don't understand what's been going on. Obviously, they've talked about circuit breakers, best price, and trading causes, but as the other speakers have said, there are two side effects of this. One is you drive the business abroad, and secondly, there is no agreement that if you introduce these, they might actually lower cause more instability in the markets, and that's why it's clearly important for when MiFID is being agreed that they need to actually get it right along with the associated regulation. So, let's move on from that. So, just in terms of recommendation, there's a lot of discussion at the moment in the UK that the whole banking system isn't working very well. One of the factors that's often quoted is that there was only one new bank created in the UK in the last century, which clearly indicates that it's not going too well. Another measure is if you look at the amount the banking system costs the United States in terms of GDP, it's gone from about 10% of GDP, I guess about maybe 30 or 40 years ago, up to where it's going above 25% of GDP. So I think what we're talking about here is that even retail banking isn't working very well. And the other thing is that on top of this, you're putting increasingly complex regulation, which arguably isn't improving the system more than just driving up the costs of actually doing business. To finish on algorithmic trading, my concern is really an engineer's concern about the construction of the algorithms and the complexity of them, and that we don't understand them. And therefore, what we need, I would say as an engineer, is you need greater diversity, and you need to actually try and find out how to actually increase resilience within individual algorithms. Because large firms in London, for example, will say, we don't know whether our algorithmic trading systems are actually fighting each other, what they call scalping, or actually scalping the competition. So this is an actual level of lack of understanding. So can we use science to actually try and improve our understanding of what's going on? And the two things that just put up there, I think we need regulatory changes to disencourage gaming. I'm not sure. I think that regulatory changes involving dark pools are going to have a great deal of difference. And the one thing that I would say is it possible for the algorithms for small firms to be in some way certified, which I think is what some of the big companies are doing with their own customers at the present time, so that these little firms aren't going to actually cause problems in the marketplace. And finally, I've said before, we're now going into MiFID, and it's clearly very controversial, and it could be very detrimental if it actually increases instability. And as they say in Britain, the road to hell is paved with good intentions. Thank you very much.